Our analysis would suggest that if there was significant trade policy changes and trade wars to take place, we think that Singapore and Malaysia are probably the most at risk. That's not to say a lot of ASEAN would not see a downturn in trade as well. But clearly countries outside the US on the trade side will be looking to enhance and embed their trade agreements and trade ties, as is Australia. Even if it does look like the TPP may be well and truly dead and buried, but we have to wait and see on that. It would certainly be the case that countries would be looking to expand those trade ties. So the thing with trade, obviously in free trade agreements, it takes a very long time to negotiate and even a longer time to implement.
Yeah, indeed. If we could drill down to where you are, Martin, you're overweight Australian banks, so I get that. You're underweight Australian staples. I'm curious about this. You're also underweight Australian REITs. If you're overweight Aussie banks, why not? Why are you underweight REITs?
Well, we think the difference there is both on valuation. The Aussie banks, although they've rallied really hard in the last month or so, were selling at a very deep discount to the index weighting levels, or valuation levels, should I say. The REITs is really more a reflection of our view on interest rates. And we think interest rate sensitives have probably had their day. The REITs have been great outperformers through last year, but they're now basically selling at or above net tangible asset backing. The yields aren't as attractive as they had been. So we think that probably from a valuation perspective, the REITs are no longer a place to be. We're really focusing in on, to some extent, the cyclical industrials and where we see some better value.